A very good morning to all and welcome to our UOB FX Invest webinar. Firstly, we'd like to thank everyone for taking the time off, be it at home or at work, to join us in this session today. We'll be touching on a very hot topic in Singapore right now that's close to many of our hearts. You hear this at home, at work, and even from that delivery guy that's bringing you lunch to you later. So how are the SMEs coping? How are they impacted or already affected by the pandemic that is sweeping through the entire world at this moment? So to kick off today's session, we have with us here Mr. Mervyn Koh, Country Head of Business Banking Singapore within the UOB's Group Retail. He oversees the SME portfolio, in particular the small business segment in Singapore. Mervyn has also led the digitalization of SME banking through UOB's Beyond Banking programs with solutions such as Bismart. So he also drives partnerships in the SME ecosystem space.
Good morning, my fellow SME business partners. We are living in challenging times. It is almost so. We see news or we hear of news every day, COVID-19. Every conversation at the dinner table or among friends is nothing but COVID-19. Well, it goes in comparison to what had happened 100 years ago, the Spanish flu, which killed more than 50 million. We can only imagine what the world was like then. But today, with advances in medical technology, with a more interconnected, we hope these numbers will be far lesser than what it was in the Spanish flu era. At UOB, we are working hard to bring relief to our customers, working closely with the government to bring out the relief programs. But still, life goes on. Today, I'm bringing you with two of my esteemed guests to talk about FX strategies and investment strategies and how you as an SME business partner could benefit from it. So I have Anthony and Kun Hao to share with you on the strategies on how we can mitigate these troubling times. This webinar will be interactive. There is the chat and there are polls there. Please actively participate in it. And to end it all, we will have a fireside chat later on to give you some of the deeper perspectives of what we are discussing today. Meanwhile, stay healthy, keep safe. Thank you and enjoy the session.
Next up, we will have Mr. Heng Kun Hao, Head of Market Strategy, to brief us on some economic updates. Kun Hao has more than 20 years of financial market experience across various key asset classes, such as FX options, derivatives, and commodities. He has also actively participated in many investment seminars in the APAC region. So before joining UOB, Kun Hao was a senior FX strategist at a Swiss private bank, so he's very familiar with how the economy will pan out during this crisis.
Good morning, ladies and gentlemen. So we've made it past the first quarter of a very, very difficult 2020. Today is, of course, 31st of March, the end of the first quarter. And I have the difficult task, basically, of discussing with all of you, what has happened so far. Now, specifically, I'm sure everybody is aware, the COVID-19 outbreak, has intensified across Europe and the US and has started to take, a significant negative impact on economic numbers across the world. Now, we all know in Singapore yesterday, of course, the MAS eased monetary policy and basically highlighted that the growth outlook in Singapore is very uncertain and very difficult for the coming year. So there will be a few slides I'm going to show in the next few minutes in terms of the macro backdrop, just to highlight how difficult, how unprecedented the COVID-19 outbreak is. Do take it with a pinch of salt. My 2 cents to all business owners, to all of you is this. Have a mental map, have a mental preparation that all the indicators, all the news headlines that you're going to read out there is going to be very negative, very depressing. Stay true to your business, stay true to your employees, stay true to your customers. Try to do your best in a difficult period, but try to navigate against the uncertain backdrop. So let's just jump straight in. The first number we're going to show, first chart, is basically the Chinese PMI numbers. Now you can see on this chart, on the right-hand side, the steep cliff-like drop in the PMI numbers in China. Anything below 50 is considered contractionary. PMI meaning Purchasing Managers Index, is a good indication of activity in the industrial space. Now, this chart is from February. You can see the numbers dropping from below 50 all the way down. You see the circle on the bottom right-hand side, around 20-ish, 30-ish, half of it, near the 08-09 lows. So this is February's PMI numbers for China, and of course, everybody knows that in China, February after Chinese New Year, basically all factories in China were closed down, and that's where you have the lockdown. Now, the good news is this. Early this morning, just about half an hour ago at 9 a.m., China's released the March PMI numbers, and lo and behold, the manufacturing PMI is now back just above 50, which is incredible. So that gives us hope that Chinese factories are back roaring, in March after the clampdown is over. And if it works out well, China will have what we call the first in, first out in terms of the COVID crisis. And hopefully, this model can be replicated across Italy, across Europe, across US, a few months down the road, once the crisis is brought under control. Now, the next chart is a bit more difficult. This is China's industrial production, fixed asset investment chart, and you can see very clearly that basically it exhibits the same cliff-like drop across February. Now, there is significant damage over the near and medium term done to China's manufacturing activity. That's a fact. And because of what's happening in the first quarter, February, March, so on and so forth, we are now downgrading our growth outlook for China. Now, you can see the table on the top right-hand side. Basically, China will suffer negative growth in the first quarter, and because of that, your growth for the full year for China is now brought down from the 6% level last year to just 4%. Now, again, if I flash the same chart for all the different economies in the world, whether it's Europe, US, or across Asia, you will see the same thing. Keep in mind, first and second quarter, across all major economies in the world, you should see negative growth, a recession-like environment, which is what the MAS warned yesterday as well. And the damage will be there towards the end of the year. Now, the good news is hopefully, if the stimulus packages across the world do their part, hopefully we'll get a slight positive growth at the end of the year and not much, of a protracted growth slowdown in the second half. So that's China's GDP outlook, 4% GDP for this year compared to 6% last year. And if you move out the manufacturing space into the retail and the tourism space, you can see again the same scary charts. This is a chart of tourism arrivals for Japan. You can see a 50% drop across February. Of course, we know that Olympics in Japan has been delayed by 1 year. Now, if I plot the same tourism arrival chart for Thailand, for Singapore, it's exactly the same thing. Tourism arrivals for any country across Asia has dropped by like 50% across February, and I'm sure the March numbers will be even more uglier. We all know that all countries are all shut down or clamped down in one way or the other. Air traffic, across the world pretty much has ground to a halt, possibly with the exception of the US. But, this is the difficult time for all of you business owners in the retail space and, of course, in the tourism space. Now, moving on, if you look at business sentiment indicators, this is the business sentiment indicator for Europe, what we call the IFO indicator for Germany. It is a survey of how businesses, owner in the country think about the prospects in the next 3 to 6 months. Again, you can see a very similar development. Numbers have dropped towards 08-09. So this is the harsh reality that we live in. And the IMF has already said that this year will most likely be the first year where global growth will be negative. And of course, because of the COVID-19 outbreak, the IMF's annual spring meeting in Washington has now been delayed. It is now a virtual meeting, and the IMF has also delayed its growth forecast for the year for the world. And we hope to see an update from the IMF fairly soon, somewhere across April. But again, suffice to say, the numbers will be frustrating. So moving away from the macro numbers, we all know they are bad. What is the impact on financial markets? What is the impact on all of you business owners? Now, the first thing is, of course, cash flow is tight. That is fact. We hear from all of you that basically, liquidity is tight, cash flow is tight, and it makes sense. Think about it logically. Factories close down, shops close down, tourism basically grinds to a halt. So there's no revenue, there's no sales. So therefore, your receivables have all dried up. But unfortunately, bills still needs to be paid, rental still needs to be paid, and that is why you have what we call, the cash flow crunch. And because globally, 90%, 80% of all payments are in US dollar. That is why you find that this, payments crunch or cash flow crunch, whatever you call it, develops into a US dollar crunch. So you can see, straight away across all economies, this is the same thing, and that generates a job market, and unemployment, a rise in unemployment. So this chart is in the US. You can see that very big spike at the very top right-hand corner. That's the US jobless claims number, 3.283 million, unprecedented for on record. The previous high in US jobless claims is basically 700,000, just under 700,000 during the 08-09 financial crisis. So you can see how this cash flow crunch has developed and now started to affect our real life, which is jobs, which is what matters to all of us. So you can see businesses across the world, countries across the world are doing their best to keep jobs, to prevent companies from having retrenchment. And so the impact, as we said, on cash flow is very clear. This chart sums up that cash flow crunch that we see everywhere. The very big thing that's happening in the US now basically is that US corporates use what we call the CP market or the commercial paper market to fund their short-term liquidity, meaning it is a 90-day debt market, short-term debt market in the US to fund their payables, receivables, to pay their wages. So you can see that red line on the top right-hand corner, the line again jumped. The cost of a 90-day short-term loan for corporate cash flow in the US has jumped above 1% and 2%. Now it is very significant given the jump compared to where it was previously, where 90-year funding pretty much is near just above zero, and now we're at 2 or 3%. So that's the difficulty right now. The US Federal Reserve has of course launched QE, and they are in the commercial paper market in the US to try to improve liquidity and basically bring a bit more orderly move back into the funding costs for US corporates. Then, extending from the short-term funding crunch, we also have a so-called the volatility and basically, a bit more lack of liquidity in the long-term bond market. Tony will talk a bit more about that in terms of his investment outlook for fixed income. But suffice to say, this liquidity crunch extends across the whole range of yield curve, and it's also affected, long-term bond yields. This chart basically is an example of key 30-year bond yields for very, very established household names, in the US. Names like Disney, names like Microsoft, and of course, Boeing and GE. Now, suffice to say, those with weaker credits, for example, Boeing, which is the red line at the very top, suffers from a bigger jump in funding costs in your long-term bond yield. This is what's happening now. So the market is very, very decisive in deciding which corporate has a bit more difficulty going forward and which corporate, probably will have a better cash flow in terms of their debt borrowing. Then extending from that, if you look at the bigger macro picture, there's this discussion right now in the fixed income market versus investment grade and high yield. Needless to say, in this environment, investment grade will survive better because of better balance sheet. And of course, the high yield, or to put it more bluntly, the junk bond market, experiences, higher cost and higher difficulty and weaker balance sheet. And that's the red line that you see in this chart. So now that we talk about the fixed income market and the macro, what's the immediate impact for financial markets? Again, I'm probably repeating the very obvious. You will notice that equity markets, you will notice that currencies are all very, very volatile over the past 1 month. And that is a fact because everybody, investors, fund managers are basically gyrating between the very, very volatile macro numbers that are coming up and also gyrating and struggling between the liquidity indicators that are coming out. So you can see this chart basically is a chart of volatility for key asset prices. You see how big the spike is. That big red line at the very top is crude oil volatility. And we all know that basically oil prices collapse, from 60 to 50 to now just testing the $20 lower bound in just a bit more than a month. This steep drop in oil prices is unprecedented, and of course we had days of limit down, in US equity markets over the past few weeks. Before the opening bell, US equity indices basically were limit down, and close for 15 minutes or more. And that resulted in VIX jumping above 30. We thought that 30 was the high for VIX. Now we're at 50 and 60. So that's the unprecedented volatility that we see in financial markets right now. And talking about crude oil literally collapsed over the past 1 month or two. Across the year, oil prices are down like 60%. Now that's very, very significant. If you're in the energy space, if you're in the commodity space, oil prices collapsing 60% is very significant. Just imagine, the product that you sell, your selling price drops by 60%. That's going to cause a lot of pain, given that your costs and overheads are unchanged. Of course, this should be very positive for transportation, for airlines, so on and so forth. But the problem over the short term is you have a big demand drop. So a drop in oil prices, is not going to help that much until perhaps half a year or 1 year later when demand starts to stabilize. And why is oil prices lower? We all know that Russia and Saudi Arabia basically couldn't agree on production cuts. So at the beginning of March, basically they decided to walk away from each other, and they've started a price war in oil where both are now pumping more oil against each other, and basically now you have excess supply with much lesser demand across the world. Now, why am I talking about crude oil? Yeah, this is very important. Beyond the energy space, now crude oil has a significant impact in all the inflation outlook in oil economy. Suffice to say, because crude oil has collapsed by half, it is very, very deflationary for all our economies, whether in Singapore, Malaysia, Thailand, or Indonesia, or anywhere in the world. Look at this chart. The blue line is oil prices, and basically the red line is your inflation outlook, in the US over the next 5 years. You can see where this is going. Oil prices go down, inflation outlook basically drops. Now the MAS has already updated Singapore's core inflation outlook, for this coming year, and the number is now a -1% to 0, meaning the MAS now sees a deflationary environment in Singapore for the coming year. So, we have strong expectations for all our central banks across the world and all the governments to try to issue stimulus to keep spending afloat, to make sure that we don't fall into a deflationary spiral. So as a quick summary, macro data is going to be very negative. Macro data is negative. Do try to shut yourself off from all the very bearish bad news, that comes out of it. And of course, because the slowdown in growth, in demand, in spending everywhere, we can expect a recession in the first quarter of the year. And finally, of course, because of that, you find that, funding indicators have all jumped and funding cost is a bit higher. There's a bit of a dollar crunch. But our view is that once we get past the difficult first quarter, if China rebounds accordingly, somewhere around the second quarter, if the COVID-19 outbreak gets under control in Europe and US, perhaps we'll have a little bit more of a reasonable recovery in the second quarter. Funding indicators will come down. And to round off this section, I'll just talk about 3 alphabets: V, U, and L. And I'm sure you know what this represents. There's a lot of discussion right now whether you're going to have a V-shaped recovery, a U-shaped recovery, or an L-shaped recession. Now, given what's happening in the US and given the difficulties that the US has in controlling the COVID crisis, it looks like a V-shaped recovery in the second half of the year is slipping a little bit away. That's the harsh fact. We are still confident of a U-shaped recovery. We are still confident that the world will get its act together. We'll get some form of a slight rebound in the second half to try to make up for all the losses, so far. But we need to highlight there is a not insignificant risk of an L-shaped, recession going forward. Of course, that's not the base case right now, but we need to be very careful given what's happening. So again, be very aware of what to expect going forward, V, U, or L. And on this note, I'll end this first part of the webinar. Now I'm going to dive a bit more into interest rates and currencies, something that is much more closer to all your businesses, given what we talk about in terms of growth slowdown, in terms of funding costs, in terms of the lower oil prices. How does that translate into where do we see dollar sink? Where do we see US dollar? I'm sure you still need to have purchases from abroad. And of course, most importantly, where do we see interest rates? So very quickly, now this COVID-19 outbreak basically has galvanized central banks across the world to cut interest rates. More importantly, interest rates are all cut towards the zero bound. This chart is basically a chart of the federal funds rate of the US Federal Reserve, and I think that sums up how steep and how significant the rate cuts are. Now you find that the Fed has cut twice, 150 basis point and another unprecedented 100 basis point. So the Fed has now dropped its federal funds rate all the way down to the zero lower bound, 0 to 0.25. And basically across the world, that's replicated across every major central bank. Bank of England, Bank of Canada, you name it, all make aggressive multiple 50 basis point cuts. And basically across Asia as well, key central banks have dropped rates like we've never seen before. Just last Friday, the Reserve Bank of India dropped their repo rate by 75 basis points. Again, unprecedented. Now what I'm trying to say is this. Central banks have done their heavy lifting and dropped rates more or less down to zero. And of course, in Europe, some places like Switzerland and the Eurozone, rates are staying in negative. Okay. The second act that central bank has done is basically to go full-scale QE, or should I say unlimited QE. So this chart, can be a very exciting or scary chart depending on how you look at it. This is a chart of the Federal Reserve's balance sheet. You see that circle on the top right-hand side. That's like the space shuttle taking off. Now the Fed has went full-scale, committed to unlimited QE, and it is intervening in nearly every market of the US, every part of the US fixed income market, whether it's corporate investment grade bonds, whether it's mortgage-backed securities, whether it's asset-backed securities, whether it's the CP market, commercial paper market that we talk about, the Fed is in orders on top of US Treasuries. And you find that this active intervention is important to basically keep long-term bond yields and short-term money market rates, low and calm as well. So this is what's happened. And across Asia, again, this chart looks a bit busy, but don't worry about which line is which. This is a chart of key central bank reference rates for all the Asian central banks, Korea, Malaysia, Philippines, you name it. You see that all the lines are all pointing lower. And that's the case as well. Across Asia, all central banks have eased monetary policy. So where do we go from here? As businesses, we still need to look forward. Of course, short-term cash flow is important at this moment, but we still need to look, 1 year down the road, half a year down the road. Everybody will prepare for eventually, the world coming out of a COVID-19 crisis. You need to plan for a long-term borrowing. Where does that leave us in terms of long-term borrowing rates? Now, this is a chart of 10-year, 5-year benchmarks of the US Treasury yield. We'll take that as a long-term, so-called funding indicator. Now, you can see basically that immense volatility over the past 1-2 months. There's a steep drop in long-term bond yields, US Treasury yields, across early March, and then followed by a reasonable rebound, and after that, choppy volatility. Now, that's the key message I want to send to all of you. And it is not a sales message. It is that because the uncertainty out there, central banks, as I said, have all cut rates, pump QE, and because the uncertainty in the macro outlook and the funding indicators, there will be volatility in the long-end rates. For those of you who track your 10-year Treasury yields, you find that it's gyrating anywhere between 50 basis point and 1%. That's incredible. In normal days before COVID-19 hit us, 10-year Treasury yields on a daily move of more than 5 basis points will catch our attention. Now this thing swings like 10 over basis point every day and 50 basis point across weeks. It's just incredible. Look at the chart. So long-term borrowing costs will be volatile. Be very careful about that, which means you may need to hedge your long-term borrowing costs at the right time when the numbers are low. I take an example, Singapore government bond yields in a 10-year. That dropped 10 basis points yesterday. And again, that's very, very volatile for a long-term bond yield. So that's for long-term interest rates expectation. What about FX? Suffice to say, COVID-19 is very negative for every other country. But the irony of it is this. Anywhere in the world you look at it, every other currency is weaker except the US dollar, which is a bit ironic. It's hitting the US, and why is the US dollar strong? Unfortunately, the US dollar is the world's reserve currency, is the world's funding currency, is the world's payment currency. So in crisis, you will find that basically, as what I said before, there's a dollar crunch. In crisis, you'll find that US corporates across the world repatriate their cash back, into their safe haven. And that's why you have US dollar strength. And before that, if you remember what I said earlier about oil price dropping by half being deflationary. A very weak oil price is very negative for Asian and for EM economies, because a lot of our economies in the emerging market space in Asia rely on energy and oil exports. So I'm sure you're aware that oil prices been low is unfortunately a negative for Malaysia ringgit, for Indonesian rupiah, and of course if you extend out to other EM countries, basically for the Russian ruble as well. This chart plots the EM FX, basically against oil prices. You can see how negative oil price is, weak oil prices for EM currencies. Expanding across, for those of us nearer to this part of the world, you can see that the Aussie and the Kiwi have literally collapsed. Again, cliff-like charts over the past 1 month, Aussie and Kiwi dropped because of the much lower growth outlook, and of course both central banks, the Reserve Bank of Australia and the Reserve Bank of New Zealand, cut rates to zero and launched QE. Now, there's a bit of hope. It appears that all governments in the world are really now doing their best, and we got to give our governments credit, whether it's in Singapore, whether it's across the world. All the governments are now dipping the reserves, opening the tap to try to make sure everybody keeps their job. Now, yesterday, Australia just announced a third tranche of a stimulus package. The numbers are big, basically trying to put cash in all the workers' pockets for the next few months. Adding all three tranches for Australia, the stimulus is now a very significant 17% of GDP. So that's incredible. Now, last week, of course, we had a Singapore resilience package. The total of it is just under 12% of GDP. So you can see where this is going. Every government in the world is now pumping stimulus to try to keep our economies afloat. And because of that, over the short term, our currencies have to be weak. And of course, this chart is the sterling pound, and you can see where this is going. Sterling pound has now dropped below the 2016 referendum low. And again, you can replicate this everywhere. The US dollar is strong. This is a chart of US dollar in terms of Asian currencies, and you can see the very right-hand side, all the lines are pointing higher. US dollar is stronger against the ringgit, against the rupiah, against everything else. So my 2 cents is this. In the next few weeks, across the second quarter, we need to live a little bit with the strong dollar environment. That's not easy, but once the funding crisis passes, once growth starts to rebound a little bit, in the second half of the year, then this will reverse, which means we would expect a slightly better environment for the Aussie, for the Kiwi, for the pound, and for all our Asian currencies, towards the second half of the year. But for now, in the second quarter, there's only one important thing, which is do not get caught short with the US dollar. If you have dollar liabilities, please do make sure you hedge. Please do make sure you pay up because of all these uncertainties. Moving on quickly, to round up, what's our expectation for Singapore? So the last 2 charts basically show what's the expectation for Singapore. Now this chart basically plots crude oil price, the blue line, against Singapore's core and all item inflation indicators. And now, as I said earlier, yesterday, the MAS's monetary policy flatlined the Singapore trade-weighted basket, appreciation to a recessionary setting. And basically, MAS warned that growth outlook this year will be difficult. More importantly, inflation will be stuck in negative 1% to 0 for this year. And this is what this is. Low oil prices is very deflationary for Singapore, and you can find that basically, if oil prices stay low and start to challenge the $20 lower bound, we'll have a little bit more challenge to our deflationary outlook for this year. So that's in terms of deflation. Now, finally, where do you expect for local currency? Where do you expect for dollar sing? For those of us who track dollar sing, you can see that over the past month, it's jumped above 140, 143, 145 in double quick time as our growth slows down very quickly, as basically our economy starts to shut down. Now, over the past few days, there's a little bit more recovery in the Singapore dollar, a bit of pushback. You find that dollar sing is back down to about 142.50 now. So the spike is not so big. So over the near term, it will appear that, the authorities have got things a little bit under control. And there's one very important point. Late last week, the MAS activated a US dollar liquidity swap with the US Federal Reserve. Going forward every week and at regular intervals, the MAS will issue term options for liquidity funding out to banks, and the banks can provide this US dollar fund down to corporates and of course, to SMEs like all of you. So, our central bank is doing what it can to try to reduce that US dollar funding crunch. And we can expect, a bit of an orderly FX market for now. What to expect for dollar sing after that? Our view is still that the risk is that the Singapore dollar may need to weaken, meaning the US dollar will still strengthen across the second quarter towards 145, 148, possibly 150 because of the intense growth slowdown across the second quarter. But after that, towards the second half of the year, things should come down. We've probably seen the worst around 150, and dollar sing will then come back down towards 148, 146, so on and so forth. So that's roughly the trajectory. And again, I will just leave with just one last note at the end of my section, which is over the next few weeks in the second quarter, if you have US dollar shortage, please do speak to your relationship managers. Please do try to hedge this risk. So on that note, I'll end my section, and I hope this has been useful to everybody. Thank you.
Hi Joanne, I'm so sorry my meeting overran.
I knew that you could be running late. Don't worry, I've actually gone ahead to secure today's favorable FX rates based on your instructions.
Thank you, Khun Hao. Next up, we'll have Mr. Anthony Raza, Head of Multi-Asset Strategy, to cover us on the investment portion. So Tony has close to 30 years of investment experience. Leading the Multi-Asset Strategy Unit, he is in charge of monitoring the markets around the world and creation of our in-house view of likely market outlook and performance. He also provides investment recommendations and manages a range of asset allocation products. Prior to joining us, he has worked overseas and here in many well-known foreign and local banks, so providing him with a myriad of experience in investment field.
Okay, good morning, everyone. So in this next part of the presentation, I'll focus on some of the investment markets, and in particular, just try to give a summary of what our portfolio managers are thinking about markets and what are our assessments of stock and bond markets in the coming quarters. So as a starting point, I would want to be clear with all investors that fund managers really clearly see two main problems in the world right now. So firstly and obviously, there's the outbreak of COVID-19 and the impact it's having on global economies. Khun Hao already summarized a lot of that impact on what we were seeing in the economies in China and the rest of the world. But secondly, and just as importantly to investment markets, the other big issue that's going on in global markets is that there's a global liquidity crunch. A liquidity crunch usually occurs because there's usually banking problems around the world. We saw that in the global financial crisis in 2008 when the banks started to come under a lot of pressure. That created a liquidity crisis. The liquidity crisis that's going on right now is kind of more driven by the fact that businesses around the world are seizing. And I'm sure the viewers of this webcast are probably very keenly aware that money around the world has sort of stopped its circular flow. Customers aren't buying products, businesses aren't paying off to their suppliers, and aren't paying wages, and everything comes to a halt. And we call this, in most economic terms, we call this the velocity of money. How much is money circulating through an economy? Because that has slowed down so much, liquidity is slowed down around the world. And we're seeing it as investors. In our portfolios, we see highly rated bond fund positions, so this would be like AA, AAA type companies, and there's no market for it. You can't sell it on to out of your portfolio if you wanted to. If you had to raise cash, there's just no way to even sell the strongest of the assets in your portfolios. This type of liquidity crunch creates a lot of volatility and a lot of very surprising pricing that we're seeing in the various asset classes. Kunhao summarized, I think, some of the key ones, how it's affecting business. He mentioned how commercial paper that is used by funding across many global businesses has dried up. There just isn't the cash flow into it that they normally count on. Likewise, portfolio managers are seeing it in their portfolios. The central banks around the world are trying to address that second problem of liquidity, and the governments around the world are trying to address the first problem of the economic impact of COVID-19 through fiscal measures. So on this first slide, let me just summarize, I guess, how we're thinking about investment markets, and in particular, this slide is some of the short-term things that we're looking at and assessing. And in particular, the way I would describe this is these were some of the things we're looking at in if the market is going to form a bottom. Equities have fallen tremendously over the last month. We've seen declines in global equities of around 30% across most equity markets. And the question is this the start, or are we forming a bottom? And to determine that, we look at several of the points that are mentioned in this slide. So firstly, obviously, we have to have some sort of sense of how the outbreak is expanding and if there's any evidence that it's starting to slow down. On this first point, our assessment is still fairly on the negative side. In particular, in the US, the outbreak seems to be raging at a very fierce pace. We're seeing in the last several days continued number of new occurrences on a daily basis that are approaching around 20,000 a day. This is worse than we've seen in any country so far and remains sort of the epicenter of where the problems are. I think if you squint, you can start to form a little bit of a positive view on the European outbreak, in particular Italy, that has had so many problems. They've been on lockdown since March 9th, and if you track their number of daily occurrences, the highest number was early last week, and over the last 8 days, they've stayed below that sort of peak number that they had early last week. And so that's a little bit of a positive sign. But they're still seeing around 4,000 to 5,000 new cases a day. And other countries like Spain and Germany also have very significant numbers. And UK doesn't look like it's slowing down either. So in Europe, maybe you can start to, if you're an optimist, form somewhat of a positive view. But really, the broad assessment of where we are now still has to be a little bit on the negative side, that the outbreak is still quite fierce. The second main thing that we look at to see if a bottom can form in markets is what the level of policy response is. And in particular, when you look back at several of the past crises and what formed a bottom, and so for example, in the global financial crisis in 2008, the bottom in the markets formed when all the big fiscal and central bank policies were rolled out. In the US, for example, it was the stimulus package and TARP and the Federal Reserve's initiatives on quantitative easing. That all occurred at the beginning of 2009, and that helped form a bottom. And after that, although the economy took a long time to recover, the bottom of the markets was formed at that point. What we're seeing right now is what we would conclude is very positive signals and very convincing levels of central bank policy support to address the liquidity crisis. and very significant fiscal policy support to support the economies around the world. And just to throw out some numbers, I think many of you are aware, but in Singapore, the fiscal package is estimated to be around 11% of GDP. In the US last week, they finalized the details of their $2 trillion package that also works out to be around 11% of GDP. In the UK, Germany, Netherlands, we've seen fiscal packages that are approaching almost 20% of GDP. So these are among the biggest measures we've ever seen governments roll out. And from an investor point of view, we would say this is a very convincing response. And a lot of this is almost unlimited in character in the way Europe is rolling it out in particular. The third element that we think is needed to form bottoms in markets is kind of more of a combination of investor behavior. In particular, what we want to see is sentiment that is sort of bottomed out and becoming very bearish. And what we want to see are all these sort of very active, systematic selling strategies to look like they've exhausted their selling behavior. We run various models to try to get a sense of has everyone really finished all their selling? And on that front, we get somewhat positive indicators that actually a lot of the fiercest part of the selling looks like it's over. So as a bottom line, if I was to ask, have we seen the bottom in the markets? I would say there's positive indications that we've gotten the fiscal and monetary policy. We've seen a lot of the selling behavior start to slow down. But there's a problem that it doesn't really look like we've gotten to the bottom of the viral outbreak. And therefore, we haven't really seen all the worst of the economic numbers yet. So our assessment is a little bit mixed. We think there's a good case that maybe we have seen the bottom, but we're a little bit leery of sticking our necks out too far just because we'd be more convinced if, in fact, we actually had seen the peaking in the viral outbreak. On the next slide, we kind of have our assessment more on a long-term basis. I think Khun Hao already just alluded to the fact that we're spending a lot of time trying to think about what is the recovery going to look like? Is this going to be a V-shaped recovery where we recover very quickly, or will we have maybe a more prolonged period of a downturn before eventually recovering, maybe in a sharp way? And on this front, it is our house view that the recovery should be quite sharp when we get it in the second half. Our cautionary comment is that it looks like there's still more to work out in terms of how this outbreak will proceed. It looks like we still have months to go of containment type strategies that are going to be implemented around the world, and that'll drag on the economies over the next quarter. We would say that it's important to note that compared to other financial crises or other economic downturns, that what we're facing right now has a better chance of a very sharp recovery. In times like the global financial crisis, there was massive housing overbuilding that really the builders couldn't build for 2 more years because there was just too much excess supply. The banks were hurt very significantly during that crisis, and they would take 2 years to recover their balance sheets. Unlike periods like in the past, what we're dealing right now is a very exogenous crisis. And it's because of this external event of COVID-19 that if that viral outbreak gets contained at some point, there's really nothing stopping the global economy from kind of roaring back. And I think the China PMI numbers that Khun Hao showed sort of showed that China had to shut down their economy for a couple of months, but their manufacturing indices are actually roaring back very significantly. And our fund managers, when we're talking to the companies we invest in China, the reports we're getting is they're expecting that by the end of March that they're going to be getting their factories back to close to 100% capacity. So as a summary on the first point, thinking about the broader long-term investing cycle, we would say for now we still have to be cautious that the economic numbers are going to get worse before they get better, but we're still kind of a base case where things can improve. On the second point, what we're watching is the survival of corporates around the world. I think the listeners of this webcast are very keenly aware that these are very difficult time to keep businesses afloat and surviving for the next couple of months. And so we're keenly watching that. Obviously, massive bankruptcies is going to make a strong rebound harder to come by. But if government policy can support small businesses, keep the workers somewhat solvent over this period, then that gives us a better chance that we can recover in the second half of the year. And then finally, the third point, when we try to think about longer term market attractiveness, we look at valuations. And our main point would be that whether or not we're looking at equities or we're looking at the spreads that are implied in credit investments, the valuations are actually very attractive now and becomes a very attractive base for long-term investing. So in the next part of this presentation, I have various slides that we just try to summarize quickly what we're seeing in investment markets and how we're building our assessments. This first one here is just the path of the outbreak, and it's the number of cases we're seeing in key markets like Italy and the US. And as you can see, as I mentioned before, the number of cases in Italy actually has sort of hit a peak in early last week, and over the last 8 days have been coming in at a moderate level, although still elevated. And in particular in these charts, you can see on the left, it's Italy's outbreak compared to China's. And you can see it's worse than China, but maybe stabilizing now. In the US, on the other hand, not only is it far worse than what we saw in China, but we're really not getting any indications that it's coming under control. And still, the numbers are somewhat accelerating on a day-by-day basis. On the next chart, I just wanted to give a little bit of sense of what we're seeing in global markets. The red line here are the global equity markets over the last couple of years, and the blue line are global bond markets over the last couple of years. And what you can see is this correction has occurred very fiercely, very sharply, and essentially has undone over 2 years worth of returns that have been adding up over time. On this next chart, I've been asked quite frequently, how does this correction compare to, for example, the global financial crisis, which you can see in this chart on green, or the Great Depression in the 1929 period, which is this line in blue, or even just the correction we had in 2018, which you can see in purple. So this current correction is in red, and what you can see, there's a couple things that stand out. So firstly, this is the fiercest and sharpest correction we've had in history. This is the first time, it's the fastest correction from a peak to a 20% drawdown that we've ever recorded in history. But while this is the sharpest correction in history, it's also fair to say that it still is not as deep as either the global financial crisis or anything like the Great Depression. And then to emphasize the point further, on this next slide, we have how this correction compares in Asia markets versus the global financial crisis that we saw in 2008, and also how it compares versus the Asia financial crisis. And again, what we see is that it is just as fierce as the early days, but on the other hand, it hasn't been as deep as those prior periods. It is our view that this doesn't have to be as deep as, for example, the global financial crisis. As I mentioned, it took years for housing and banks to recover, to fix their balance sheets in those prior crises. In this one, all we need to do is get control of the outbreak, and then there's a chance for the global economy to rebound very quickly. I also have a couple charts here comparing how this market is comparing versus other viral outbreaks. And in particular on this chart, this purple line is the markets that we're seeing now, whereas the blue line are the global equity markets during the SARS outbreak, and the red line is during the MERS outbreak. And what stands out is while equities corrected by 10% in the SARS outbreak, currently they've broken way below that to 20 to 30% drawdowns. And on the next chart, this is the Asia markets. And the Asia markets corrected by 14% during SARS in 2003, but this time they've corrected even more. We're currently looking at 25 to 30% drawdowns. On the next chart, we highlight global bond yields. We would note that bond yields over all these periods did come down, and this is a very common pattern of sort of a flight to quality that we've seen in markets over all these periods. And then finally, before I just get into our summary of our assessment, is just similar to what Kuhn has already shown, we're getting data points all over the place that are showing very sharp economic contractions. The first ones we started to get were in China, and on this slide we just summarized some of them, that the manufacturing indicators contracted very sharply, passenger traffic contracted very sharply, the use of resources like coal contracted very sharply. And so there's lots of evidence that we need to be very conscious is going to affect global economies. When it comes to our overall assessment, our recommendation is still to be neutral equities, a little bit overweight fixed income. I think some investors and clients that I speak to say, though, they're surprised, wouldn't we be selling everything at this point? These markets are so bad. And the answer is no. And our recommendation to, I think, most clients would be that markets are going through a very sharp and difficult period right now, but that our advice would not be to sell into these markets. Our advice in many cases is do nothing is actually a pretty good strategy. And for those that have the capacity, there are opportunities out there, although be mindful that things are going to be choppy for the next quarter. On the next chart, we have a more detailed breakdown of how we're investing in the stock and bond markets around the world. To keep it simple, I would just say that we're actually pretty neutral across a geographic basis. We're increasingly sort of warming up to the idea that Asia is doing the best right now. And then in fixed income markets, we tend to be a little bit more conservative with good quality credits and a little bit shorter duration. And then finally, as just a couple final charts, we have the valuations of markets around the world. And in particular, this is a chart on the PE valuations of equities on a global basis. And you can see that a couple of months ago, global equities were a little bit on the expensive side, and their PE multiples traded about 1 standard deviation above their average levels, and currently now they're at 1 standard deviation below their average levels, and valuations have gotten very attractive. And the same story holds for Asia, where Asia has gone from a little bit expensive to actually very cheap now. So I'll pause there and use that as our summary. Again, our message is while the assessment over the next quarter remains challenging, our base case is that there remains ample opportunity with all the policy that's rolled out, that if we can get control on a global basis of this virus, that a second half recovery still remains a fairly solid base case assumption. So thanks for listening to that part, and I'll pause there and we'll turn it over to our discussion part of the presentation.
What is investing to you? At UOB Asset Management, we make sense of money. Now, let us help corporate investors to invest digitally with UOB AM Invest, Singapore's first digital advisory service for corporate investors. Using intelligent technology, we bring you access to the capabilities of one of the most awarded fund houses in the region with our top-rate investments. Let us partner you in this journey and support your corporate investment needs tomorrow. UOB AM Invest. We make sense of money.
Thank you, speakers. Hope everyone who are listening in finds the presentations insightful and interesting. We will now invite our 3 speakers to have a dialogue to discuss further on today's topic and also to answer some of the questions that came in earlier.
All right, guys, it was very insightful what you shared this morning. A lot to take away. Let's break down this fireside chat into bite sizes for our audiences that what they can take away with. All right, perhaps that's while the team is trying to sort of get the poll questions. Perhaps I'd like to ask in terms of the view on the containment strategies, and I know Khun Hao spoke about the U-shape or the L-shape or the V-shape recovery. Now, no one knows what it's going to be like, but what should SMEs look out for, or what strategies should they take on if it's, say, a V-shape, a U-shape, and L-shape? Perhaps Khun Hao, going to start with that.
So I guess, there's, as we've all discussed, Tony and us, there's so much discussion on whether you believe in a V, U, or L. everybody has a strong case either way, right? Suffice to say, the longer you drag on, it becomes a bit more of a U. I would say that the common denominator amongst all this is how long will the shutdown be? Meaning, how long will planes be grounded? How long will tourism, stop? How long will factories close? Because the longer you shut down, the longer you run the risk of what we call, asset impairment. Because eventually, if the plane is grounded for too long, possibly you need more capex to try to get it to fly again. The same for factory lines. Those of you who own factories, basically, if your factory is shut down for 3 months or more, you may need to spend more to try to get it to restart again. So I think what we would like to look out for is basically once you find that industrial activity in China starts ramping up fast, that's a very hopeful sign. And as I said before, I will hope that China is a bright case for first in, first out. If let's say China can recover strongly in April next month, they have only 2 months of downtime, then hopefully that's the case for Italy, that's the case for US, and we can replicate that. So I would look out for Chinese manufacturing indicators.
Excellent. Tony, your view?
Yeah, maybe the thing I would add on is I guess for most businesses, just be aware of maybe what is, and I don't mean to be too rosy about this because obviously there's risks all over the place, but the potential scenario is that these fiscal packages help keep a certain amount of businesses survive for the next few months. It helps keep workers with food on their tables. And then as the virus subsides and maybe the warmer months over the summer helps address it and the lockdowns work to some extent, you might get a path like China where you can bounce back. And therefore, I don't mean to be too rosy about it, but if that's still a legitimate path for the global economy, and if so, then what businesses need to do is find a way to survive the next few months and be ready for what is probably going to be a fierce snapback. You'll get global consumers that have been doing nothing for the last few months and will want to go out and do things again. The slowest part, I think, as Kuhn was saying, is it's hard to see how travel is going to bounce back as quickly. That one looks like it's going to take more time, but even that, I think I myself, I bought tickets for December at a really cheap discount holiday package. And I thought by then things should clear up and we're going to want to get out and do things.
Let's wager to that.
Yeah.
Yep.
Just to add to what Tony said, so I saw a news article yesterday that says, from the moment you fly from Singapore to Shanghai to reach a hotel, now it takes 26 hours.
Oh, yes.
After all the immigration checks, the health checks. So maybe that's the new normal. Now the next time you travel, instead of just hopping onto a plane and straight in the hotel, it may be a few more hours in between. So as what Tony says, it's going to be difficult for travel, and you have to adjust accordingly.
Sure do. All right, let's focus on the poll results. Do we have the poll results up? Yes. Okay. So I think the audience, if you all can see the poll results, all right, so let's start with the first question. How much cash flow does your company have to ride out this period? Well, more than 60% says they have more than 6 months, or 6 months or more. What are your thoughts on that?
Well, I would think that's very, very heartwarming. It would say that, generally, Singapore businesses are very cautious and well save up for the rainy days. I mean, if I were to extrapolate this, this is also, how, cautious, the Singapore government is in terms of the fiscal, stimulus. Okay, we have a strong, reserve, and basically because of the thunderstorm now, as what, Deputy PM Heng said, we now are drawing the reserve. So I suspect this 6 months is probably the reserves of a lot of our SME corporates. And it has to be drawn down, but the good thing is they have a 6 months reserve and cash flow to try to tie over this period.
All right. And if I were to dimension this with, capital preservation or opportunistic investment against the strong US dollar, but at very low interest rates, what would you recommend?
Yeah, I mean, so I think times like this, they're volatile enough that you still have to be mindful of your capital preservation and not sticking your neck out too far. But, and I see the survey results, it looks like there's at least a fair amount of clients out there that are interested in things like equities. And I would highlight that within equities, obviously we're seeing very attractive valuations. I think we're seeing Asia markets that have been beaten down for a couple of years because of that whole trade war that seems like a distant past, but has kept valuations more moderate. We see a lot of attractive stories, like in the technology space, that whole FANG part. There's been a lot of money printing and global liquidity injection. It tends to go to hot stories like that if the dust settles down, and I would look out for that opportunity. I could see that as something that becomes sort of bubblish once all the dust settles. And the other one I would say is there's just a lot of pricing distortions. We see good corporate bonds that are getting no bid, and their prices are falling a lot, even though these aren't the types of companies that are under any pressure of default or anything like that. And so those type of opportunities are out there too.
Let's take a question from the audience. We've got one question. I pay for goods in euro. How will I be affected in the next 6 months by the latest MAS policy?
So as a quick recap, what happened the MAS did yesterday was basically they zero-line or flatline the pace of appreciation for the Singapore dollar on a trade-weighted basis. This is what the MAS calls the senior policy. Now, what this means is basically this: the Singapore dollar, in a normal economic setting previously, slightly appreciates gradually against other currencies, our other trading partners. That's because we want a stronger Singapore dollar. It's more stable and it keeps inflation down. Now, in this current recessionary setting, because of COVID-19, the MAS flatlines everything, which means the Singapore dollar will no longer appreciate on a trade-weighted basis. So that means we tend to move in sync with other currency pairs. So whether it's Euro Sing or Aussie Sing, so on and so forth, or Sterling Sing, I would say then, remember what I said earlier, we have a dollar funding crunch. That's the main denominator now. So Sing dollar will stay weak against the US dollar, but against the Euro, Aussie, or Sterling for that matter, it'll range within a volatile range. So Euro Sing, to be more precise, it went up from about 150 to 155, 156 now. I suspect the broader range across the next 1 year will be anywhere between 150 and 160, depending on how things pan out. So if you need to buy euros, the next time this dips down towards the low 150s, 152s, 153, perhaps you can put in a bit. But if you have repatriation, you have revenues from Europe, it goes up to the high 150s, 158, then you can start to bring some back.
Okay. Another question, do you think this is just a bear bounce, or you recommend to go to the market now? And again, we have put some disclaimers on that.
So how about, I'll summarize, with our portfolio managers, we've been debating this fiercely over the past week. And the way I would just summarize it is that there are several things that sort of are in line with calling this actually the bottom of the market, and this is not just a bear bounce, a dead cat bounce, or anything like that. The plus points on the argument for that would be that, one, we've seen in the past, once you've rolled out the policy initiatives like we've seen over the last week, this is when markets tend to form their bottom. Additionally, when we look at kind of more technical factors of a lot of these kind of more trading strategies that are tied to how much volatility in the market is and how much they have to sell, it looks like they've pretty much exhausted their selling, and those types of things sort of give us confidence that we've cleared a lot of those who need to sell. The only thing that sort of keeps us from more convincingly sticking our neck out and saying, yes, we formed the bottom, is just that the outbreak just hasn't been controlled yet. And I guess we saw that in the example of SARS. Markets found their bottom once the number of cases started to decline. And we also saw it in China. The China market started to outperform once their cases started to decline. And so with the US sort of still soaring in the number of cases, it feels, I'd say that's the one weak point from more convincingly sticking my neck out and saying, yeah, no, we found the bottom. There's a risk we could make a new low if the US case outbreak looks really horrific.
Well, I reckon it's going to be worse than what we see today. But there is a related question. It's do the unit trust manager actively manage and rebalance the funds now? What's your comment on that?
Yeah. Yeah, so there's a lot of things that are going on. One, we have to maintain a lot of controls on the risk management front. We have a lot of sort of volatility controls, and those types of things sort of force us to keep actually sort of reducing at some points. But a lot of the fund managers see great values, and if anything, they want to be buying, and they see opportunities all over. At our morning meetings, people are throwing out ideas. Can you believe you can get Disney with a 400 basis point spread? This sort of thing we're just seeing, and we want to jump on that instinctively. But then the risk management controls sort of suppress that and say, no, you can only do so much. So it's kind of a balance.
All right, gentlemen. Any final comments? Before we end this session.
Maybe I'll just add on one thing. I saw in one of the surveys that says, where would you place your money? There's a bit in fixed deposits, 1/3. I guess that's always a safe haven, and Singapore's banking deposits are pretty much as safe as it can get anywhere in the world, right? But that's an inefficient way of using your cash right now. There's a little bit 15% on gold, and I thought I wanted to touch on that. Yesterday we just upgraded our gold forecast. We raised our gold forecast to $1,008 per ounce by the first quarter next year, in the next 1 year. We're now just above 1,006. And the logic is very, very simple, because every other central bank out there is printing money, QE. Every other government out there is dipping into reserves, fiscal stimulus. In fact, our spreadsheet for keeping track of monetary and fiscal stimulus, we're starting to lose track of how much reserves, how much stimulus, as what Tony said, is coming in. So if you ask, what is a strong investment proposition, perhaps it's gold, because of the amount of fiscal and monetary policy stimulus. And as what Tony said, portfolios can be volatile. Equity markets can be volatile. So you need a little bit of a stabilizer. So my 2 cents is perhaps add a little bit of gold-related investment in your portfolio to try to stabilize this. At least it's got the backing of the massive amount of stimulus.
It's always nice to have a bit of shine on your investment then.
Oh, indeed.
All right. And Tony, any parting words?
Maybe just, I guess then as a final summary, I mean, I do like to highlight to clients, not only to see how bad things feel, but the positives are that this is more policy support than we've ever seen rolled out in history, and it may be for only like a 3-month problem. And by the end of the year, we might be almost dealing with the impact of huge stimulus on top of what was a fairly temporary problem. On the other hand, I would admit I've been pretty discouraged, as I'm originally from the US. I've been in Singapore for more than 20 years. But watching the US handle this has been really disappointing. And I keep feeling sort of surprised to the downside on their ability to control this. So to me, it's a balance of those 2 things. It is disappointing how much it's getting out of control in the US. On the other hand, be aware there is a path through this if it can be settled down in the outbreak.
All right. Wonderful. Gentlemen, thank you for this morning. And to the audience of this Facebook webinar, thank you for your time. Remember to speak to your investment specialists and FX specialists, and that's what we have at UOB. So thank you, and I wish you good health and stay safe.
Thank you all for joining us on our FX Invest webinar. Hope you have an insightful session. Do click on Contact Us if you have any further queries. Please feel free to reach us at 6259-8188.